Imagine waking up to a cancelled $250 billion order. This isn't a nightmare, it's the reality for the US car industry. In an announcement that sent shockwaves through the global automotive sector, China recently cancelled a colossal car order from the USA. This isn't your everyday business hiccup. We're talking about a deal worth $250 billion. Let that sink in for a moment. The magnitude of this cancellation is staggering. To put things into perspective, this deal alone is worth more than the entire GDP of Finland or Vietnam. It's not just a massive blow to the US car industry, but it also has profound implications for the economic dynamics between these two superpowers. The US car industry, which was set to benefit immensely from this enormous deal, now finds itself in a precarious position. A cancellation of this magnitude could result in a significant loss of revenue, potentially leading to job cuts and a downturn in the industry. It's a reality that's hard to grapple with, and the ripple effects are bound to be felt across the entire US economy. On the flip side, China's decision to cancel the order is also a bold move on their part. It's a decision that could potentially affect their domestic market and their international relations. The implications are far-reaching, and the impact will likely reverberate through their economy as well. The cancellation of this mammoth deal is a prime example of how interconnected the world's economies truly are. The repercussions aren't confined to the US and China alone. They could potentially ripple out to affect global markets and economies. Indeed, the reverberations of this unprecedented cancellation are just beginning to unfold. This is a story that's far from over, and we'll be keeping a close eye on the developments as they happen. Because when it comes to the world of international trade and economics, one thing is certain: nothing happens in isolation. The repercussions of this cancellation are just beginning to unfold. Rewind back to when this colossal deal was first inked. It was a time of great excitement, a beacon of hope for a thriving future. The deal was nothing short of monumental, marking a significant milestone in the US-China trade relations. An order of $250 billion worth of cars destined to journey from the assembly lines of Detroit to the bustling streets of Beijing. This wasn't just any deal. It was a testament to the power of economic cooperation, a symbol of mutual growth and prosperity. It involved the biggest names in the American auto industry: Ford, General Motors, Tesla, all lined up and ready to deliver their finest vehicles to China. The order was diverse, comprising of a vast array of vehicles, from sleek electric sedans to brawny gas-guzzling SUVs. This deal was a reflection of China's growing appetite for American cars, a testament to the global appeal of American engineering and design. The projected benefits for the US car industry were immense. It promised to create thousands of jobs, boost the economy, and solidify the US's position as a global leader in the automotive industry. It was a golden opportunity for American automakers to showcase their prowess on an international stage, and the deal had the potential to usher in a new era of prosperity for the industry. But with the cancellation of this order, the optimistic future that was once within grasp has been cast into doubt. The ripple effects of this decision will likely be felt far and wide, affecting not just the parties directly involved, but the entire automotive industry as well. The deal promised a bright future, but that future is now shrouded in uncertainty. Every cancellation has a backstory, and this one is no exception. Let's rewind the clock a bit. The journey of this massive deal began with a promise of strengthening ties between the two giants, the United States and China. The United States, known for its robust car manufacturing capabilities, aimed to tap into the burgeoning Chinese market, while China saw an opportunity to satisfy its growing demand for high-quality vehicles. But the road to this cancellation was not paved with roses. The first signs of trouble emerged with the escalating tensions between the two countries. Trade disagreements began to simmer, often leading to public spats and retaliatory tariffs. The once promising deal started to show cracks, and the prospect of a smooth sail seemed increasingly unlikely. On top of this, changes in China's domestic policies further compounded the issues. China has been making significant strides in its pursuit of becoming a global leader in electric vehicles, investing heavily in homegrown companies and technologies. This strategic shift seemed to cast a shadow over the deal with the United States, which was primarily focused on traditional combustion engine vehicles. Additionally, disagreements over the deal specifics didn't help the situation. There were rumblings about the terms of the deal not being as lucrative for China as initially thought. The pricing, the delivery timelines, the after-sales service, all these started to become points of contention. And let's not forget the elephant in the room, the global economic climate. With the world economy going through a rough patch, large-scale deals such as this one started to seem more like a gamble than an investment. All these factors combined to create a perfect storm, leading to the eventual cancellation of the deal. It was a series of unfortunate events that led us to this point, a point where a deal once hailed as a landmark agreement ended up being axed. The road to this cancellation has been anything but smooth. With the deal off the table, the dust is now beginning to settle. As we venture into the aftermath of the colossal cancellation of a $250 billion car order by China from the USA, the immediate impact on the US car industry is palpable. The US car industry, which had been banking on this mega deal for a significant boost, is now facing an abrupt halt. This cancellation is not just a one-off hit, it's a seismic blow that sends ripples across the entire automotive sector. Companies that had been ramping up production in anticipation of this deal are now left with excess capacity. This could lead to job cuts and could potentially push some companies into financial distress. The ripple effect extends beyond the car manufacturers to their suppliers, dealerships, and the communities where these businesses operate. But the reverberations of this cancellation won't stop at the US borders. The global automotive supply chain, intertwined and interdependent, could also feel the impact. This could lead to a slowdown in the global car industry, affecting countries far beyond the USA and China. Long-term, this could potentially reshape the US car industry. Companies may need to rethink their strategies, focusing more on innovation, sustainability, and domestic markets to ensure future growth. But what about China's next steps? It's a pivotal question. Will they look for alternatives, or will they focus on domestic production? The answer might be a mix of both. China has been ramping up its domestic car manufacturing capabilities. They have been investing heavily in electric vehicles and autonomous driving technologies. This cancellation could serve as a catalyst for China to double down on these efforts, accelerating the growth of their domestic car industry. On the other hand, China could also look for alternatives, diversifying its supply chain and reducing its reliance on the US. This could open up opportunities for car manufacturers from other countries, creating a new global dynamic in the car industry. The aftermath of this cancellation will be felt for years to come. It's a significant moment, not just for the US and China, but for the global car industry. It's a moment of change, of adaptation, and potentially of innovation. A moment that will be written into the annals of automotive history. As we navigate this new reality, the question remains, what's next for US-China car trade? In the wake of China's unprecedented cancellation of a $250 billion car order from the USA, we find ourselves on the brink of an uncertain future. So let's delve into the potential scenarios that might play out. For starters, there's the possibility of a resolution. Despite the current tensions, it's not unlike the two economic giants to find a common ground. A renegotiation of terms, a re-evaluation of tariff policies, or a new trade agreement altogether could restore the balance. This could lead to a resurgence in car trade, perhaps even stronger than before, as both nations understand the mutual benefits of their trading relationship. Yet, we cannot ignore the potential for increased tension. The cancellation of such a significant deal could further strain relations between the two countries, leading to a more prolonged trade war. This could result in higher tariffs, stricter regulations, and a decrease in car trade between the two nations. But what if this cancellation leads to a shift in the global car trade dynamics? The vacuum left by the US could be filled by other car manufacturing countries. Europe, for example, with its strong automotive industry, might seize this opportunity to expand its market presence in China. This could significantly alter the global car trade landscape, with new alliances formed and old ones redefined. Moreover, this event could serve as a precedent that influences future deals between the US and China. It may lead to more cautious trade negotiations, with both countries being more wary of potential fallout. The stakes are higher now, and future deals will likely reflect this new level of risk. In conclusion, the future of US-China car trade is far from certain. Whether we see a resolution, increased tension, or a shift in global car trade dynamics, one thing is clear. This cancellation has set a new course for the automotive industry. Only time will tell how this dramatic turn of events will reshape the landscape of global car trade.